Hello, everybody, and welcome back. The rapid spread of artificial intelligence in our daily lives is also shining a spotlight on the asset management industry. Long known as a form of quantitative strategy, the question arises as to how AI is changing portfolio management and how investors can benefit from this technology. I'm delighted to have a pioneer in this field as my guest today. A warm welcome to David Wright, co-head of Quest Quantitative Strategies at Pictet Asset Management.
Thanks, Thomas.
David, can you give us an overview of the state of AI development in the field of quantitative investments?
Yes, very happy to. And thank you for the interest and the opportunity. I view in some industries and even in some parts of finance that AI is a revolution. We're at a sort of changing point here. But in the quant industry, the quant part of investing in particular, I view this more of a longer term evolution. It's something now that has been going on for the last 10 to 15 years as part of a kind of broader demand for more data, more technologies, new ways of generating alpha in investing. And today, quant investors use a variety of different quantitative AI systems. That can be from using natural language programming, large language models to help analyze text from hard to reach data sources, right through to actually using machine learned prediction models to actually generate stock return forecasts that will drive positions in portfolios.
Can you explain how your team develops and implements AI models for your so-called Quest strategies?
Yes, particularly in our Quest AI strategies, the focus is to use machine learning to generate our return forecasts that help us derive the positions in our portfolios. And there are three steps to a machine learned stock forecasting model. The first one is the data preparation. So it's defining the information that we want to train the algorithm with, that it learns from. And we generate hundreds of different signals or features from different types of data. We then have to define the target. What do we want to teach the algorithm to be able to forecast? And this is a relatively short-term strategy, so a 1 month forward forecast for the returns in a broad universe. We then have to make sure that we have those inputs and those outputs over decades to make sure that the training is able to happen over multiple different environments. That training is then undertaken with something that we call gradient boosted trees, which is a machine learning technique. We train with the data, the features and the targets, and the algorithm then sequentially, so learning in turn from the errors of a previous iteration, starts to learn which of those features are most predictive in forecasting the target. Once we have that, we evaluate it, and as individuals, we refine it and train it in many, many different ways. That live model is then used on a weekly basis where we feed in the inputs through that trained algorithm, and it gives us fresh output predictions that drive the positions in our portfolios.
What types of data do you use in your Quest strategies, and how do you ensure that the quality and relevance of the data used in your AI models is competitive?
It's such a key point here. I mean, one of the things that I try and get across to people interested in this space is, even though it's very tech heavy, there's a lot of human decisions that go into how you train a model, what the model is going to end up looking like. And clearly, the types of data you use are key. I kind of split this a little bit. Do you want to use more traditional financial data that has a lot of breadth, a lot of history, has shown to be effective, but is potentially more used and crowded? Or do you want to go the alternative data route? Some of the more interesting data sources, your social media postings, your smartphone locations that might be shorter, less coverage, and maybe been less effective historically. I think a lot of people think machine learning, AI, it goes hand in hand with alternative data. But actually what we've found is using standardized data feeds, fundamentals, market activity, investor positioning, sell side forecasts, they have such long history. We have feeds that already are able to structure and clean them. And the fact that they have a lot of breadth in them as well means that we can build these features for every company in our investable universe. So we actually have made the decision to use some of those more traditional data sources than some of the more alternative data sources.
How do you measure the success of AI-driven models? So are there specific AI benchmarks or outperformance metrics that you are using for the evolution of the model, or is it more the traditional portfolio management metrics that you're using?
I mean, a first pass, at the end of the day, we're building portfolios here that we want our clients to invest into. And our clients have expectations around what those portfolios will deliver in terms of risk and return, whether and information ratio and Sharpe. So clearly, there has to be a standard expectation how we measure this. Once we go a level down, which I think is clearly what the question is more sort of asking here, accuracy of the model and the stability of those forecasts is very, very important to us. So in quantitative strategies, however good that quant strategy is, your actual forecasting ability at an individual stock name is not that high. It's in the region of sort of 4, 5, 6%. It's when you combine lots and lots of those forecasts up together in a broadly diversified portfolio, you can start to generate sort of consistent positive results. So as an investment team, we're very focused on, do we have the accuracy from that modeling, that forecasting? How sustainable is it? How persistent is it across different market environments? But what I would say, the actual that actual way of assessing that accuracy, it's not really that different with an AI model than with a more traditional quantitative model. So it's sort of assessed in the same way.
What role do human analysts play in such a strategy, in such a highly automated environment? And are there areas where human insights remain indispensable?
So there can be misconceptions what people are often doing with machine learning. So maybe just I'll highlight a couple of the human involvements here. So firstly, again, we're training an algorithm, we're structuring an algorithm with input and output data historically. But again, which data we're using, which seed algorithm we've chosen to use, which horizon that we do this over, thousands and thousands of different structuring decisions have been made by the portfolio managers that develop this strategy. So again, you could come up with very different algorithms, even given a lot of the same inputs. There is a second element then in deploying this strategy. So once we've made our forecasts on a weekly basis, and we've combined this into a risk-adjusted portfolio, lots and lots of different positive and negative views versus a benchmark, with the output is a trade list to get us from our current portfolio to our future one. Now, some people would be comfortable just trading on that directly. We like to have an additional layer of risk management at that point. So there might be something in the modeling when the model last ran the day before that has come out about a company that is not being incorporated into the forecast. So our portfolio managers at that point will be checking for any sort of key news that's coming out in the marketplace that might be impactful on an individual name. Now, it doesn't mean that they can say, we're buying stock A, I'd rather buy B. But what they can say is the model is not aware of something big that's happened on stock A. I'll strip that out from the trade. So you do, in my view, you want that additional element of checks and balance, even on an AI-driven process.
I think checks and balances is a good keyword for the next question. So AI can be a bit of a black box to technological outsiders. How do you communicate the value and workings of an AI-driven investment strategy to clients who may be less familiar with quant and technology?
So again, this is clearly a concern and a risk that has grown with the use of machine learning, but you alluded to it. That concern has always been there with quant strategy. So firstly, it is willing to be, in my view, as a quant investor, and I would think this isn't true of the entire industry, is a willingness to be transparent with clients about how your processes work and how outcomes are driven. In the practical sense, what's that meant for us? Well, actually, the work that we're doing now, running live AI-driven strategies for close to 18 months, were actually seeded quite long ago, about 5 years ago, with a relatively academic focus on writing a paper after some work that was done to actually attribute the performance of machine learning models. So could you crack into the machine learning and understand what was driving the positioning and where the performance was coming from? So that actually seeded our whole effort here. And I used a bit of jargon earlier on, using a gradient boosted tree as the type of AI that we're using to make our forecasts. One of the benefits of using that approach is that you actually can interpret the results quite effectively. You can go back up the different thousands of different tree models that you use. So as we sit here today, every single position in our portfolios, we can attribute back to certain features within the model, the relationship between those features, and then we can aggregate those things when we look at the live performance and actually demonstrate to clients where the performance is coming from.
What challenges or limitations have you encountered in developing and using this AI model, and how do you deal with these limitations?
Yeah, I'd kind of split this into two things. So I'm going to answer the first part slightly differently. So where is it better to use machine learning? Is what have we learned? And again, a potential limitation there. We do find forecasting over the shorter horizon, AI is more effective. The data is faster moving. There are more relationships between the data. So when we take a view over the next month, for example, machine learning is an incredibly powerful tool. When you're into the longer horizon, even as a quant investor, 3, 6, 12, maybe 18 months, probably as far out as we would ever go as a quant investor, we find more traditional risk premium type strategies are still more effective. And you don't really need machine learning to understand and use those. Then on a more sort of like machine learning type answer here, one of the biggest risks is overfitting. Overfitting is where the model fits too closely to the training data, but then doesn't make accurate predictions with new live data. So we do a lot of different cross-validations, testing these things in different markets, testing it over different periods to make sure it's adaptable. And then we also do something called ensembling, which is combining lots and lots of different models together. Individually, they might not be that accurate, but combining them together, they work very well. And actually, they're much better than using one very accurate model that might be overfitted.
Take a look into the crystal ball for us. How will AI change quantitative investing, and when will we reach singularity in investment management?
So I go right back to the start here. I view this as just long evolution. I mean, quant investing has now been around for the best part of 40 years. And it's always just used more and more and more technology. But that being said, we still have a lot of human investors involved within the process, designing these things. So I think there's always going to be the balance between having a human understanding of the markets and then feeding that into the types of technology and data that you use. I also don't see a great demand for convergence from clients. Again, I view the most effective way to use machine learning is in predominantly lower risk, well-diversified portfolios or levered long-short strategies. And clients outside of that do tend to like in the higher risk, more long-only type strategies, more concentrated. The more judgmental managers should really reign. And frankly, I don't see too much different in the results. Now, the fundamental managers, I think, will start using more AI, but they'll be tools. They won't be taking over their investment process. It will support their investment process. So I don't see a convergence in the way that investing happens, and we find that one singular way.
So this was David Wright from Pictet Asset Management. Thank you very much, David, for sharing your insights into AI in investing and your work there over at Pictet.
Thank you very much for having me.